Before starting to video, we have a perfect app for beginners and those who still want to learn more. In this app, you can practice trade, learn about things like candles, indicators, fundamentals, etc. And for Indian traders, we have daily end-of-day analysis and more coming soon. Check out the description to get the web app right now. Traders, I hear you loud and clear. If you've been around the block with price action, you've probably seen every variation of the usual suspects. And it's time to go deeper into territory that's truly off the beaten path. Those mainstream setups like pin bars or engulfing patterns, they're table stakes now, arbitraged by every algo on the street. To really dominate Nifty and Bank Nifty, where FII flows can flip the script in seconds, you need the underrated price action concepts that peel back the layers of institutional deception. These are the subtle signals buried in the noise, ones that most traders overlook because they demand patience and a keen eye for the unspoken battles between buyers and sellers. I'm Trading Core, and in this session, we're cracking open 5 completely fresh, lesser-known price action concepts tailored for the Indian market: the false echo reversal, the compression shadow, the momentum echo fade, the level echo trap, and the displacement echo chain. No repeats from before, no springs, no sweeps, no gaps or stacks here. These focus on the echoing nature of price movements, where past actions reverberate into future setups, revealing how institutions echo their intent through subtle repetitions in wicks, ranges, and displacements. We'll dissect the psychology driving each one, why it's criminally underrated, precise spotting techniques on clean charts, step-by-step trading mechanics, risk tweaks for volatile NSE sessions, pitfalls that wipe out the unwary, and confluence strategies to stack edges. Pure price action, no tools, no fluff, just 5-minute, 15-minute, and daily time frames on platforms like Kite. Let's roll. To set the stage, consider the essence of these echo-based concepts. Nifty and Bank Nifty pulse with echoes, repetitions of price behavior that stem from institutional memory. A move doesn't vanish, it leaves ripples that smart money exploits, creating self-fulfilling prophecies. Underrated setups like these thrive because they're not flashy. They whisper where others shout. Retail chases the obvious, but institutions echo their plays quietly, building positions through mirrored actions that resolve in explosive ways. Trade them with 0.5% risk caps, honing in on 9:30 a.m. openings or 2:30 p.m. London surges when echoes amplify. Patience is your ally. Wait for the repetition to confirm, or the market will echo your losses right back at you. First up, the false echo reversal. The false echo reversal captures how price mimics a prior move only to betray it, creating a mirror image fakeout that reverses into the true direction. At heart, it's about a candle or range echoing the shape of an earlier swing, say a 100-point upthrust, but with inverted conviction, like a smaller body and exaggerated wick, signaling the echo is false. Why underrated? Traders hunt for exact repetitions, but this twist, the false mirror, exposes institutional feints, where smart money echoes retail expectations to lure them in, then pulls the rug. Psychologically, it's a mind game. The market replays history to build false confidence, trapping positions before the real narrative unfolds. Spotted on a 15-minute Bank Nifty chart by comparing swings. After a clear upswing, watch for an echoing down candle with similar range, but a wick twice as long, closing in the original direction. That's the false echo. Enter on the close, riding the reversal back toward the prior swing high. Stop sits 15 points beyond the echo's extreme to dodge extensions, targeting a 1, 3 reward or the echoed swing's origin. Pitfall numero uno, confusing a true echo for false. Filter by volume drop on the mimic, ensuring it's a hollow imitation. For risk, have your size if the echo spans multiple candles, preserving capital in chop. Confluence with a nearby level echo amps reliability, turning 55% base hits into 70% setups. On Nifty, this resolves echoes and trend pullbacks, quietly fading the noise for steady edges. Transitioning smoothly to the compression shadow, this concept uncovers the dark underbelly of tight ranges, where shadows, those probing wicks, hint at impending releases. Compression forms a narrow band of 4, 6 candles, bodies squeezed to 20, 30 points, but shadows stretch out like fingers testing unseen waters. Underrated because compression gets labeled consolidation and ignored, yet the shadows are the storytellers, echoing unresolved tension from prior volatility. Psychology bites here. Institutions compress to shake out weak hands, using shadows to probe liquidity without commitment, building a shadow ledger of potential directions before the coil snaps. On a 5-minute Nifty chart, identify compression after a 200-point move. Shadows must extend beyond the body by 2x, alternating directions to show balanced probing. Trade the release, enter long on an upside shadow break with body confirmation or short the downside. Stop anchors at the compression midpoint, 20 points max risk, targeting the shadow's full projection, often 2-4x the range. Avoid the trap of trading every probe, wait for shadow alignment, 2 in the same direction, or you'll echo false starts. Manage by trailing to break even after 1, locking in the echo's energy. Layer with momentum echoes for confluence, boosting expectancy in Bank Nifty's lunch hour squeezes. This shadows 60% of compressions into clean runners, exploiting the market's elastic snapback. The momentum echo fade takes us into the realm of overextended thrusts that repeat weekly, fading into oblivion. Momentum echoes when a strong candle, say 150 points, replays in a smaller version 2 to 3 bars later, but with a doji-like close, echoing the thrust peak without sustaining it. Why underrated? Fades get dismissed as counter-trend gambles, but this echo version pinpoints institutional distribution, where smart money mirrors the thrust to offload while retail reloads. The psychology is exhaustion masked as continuation. The echo lures dip buyers only to fade as sellers echo their dominance. Traded on a 1-hour Bank Nifty chart. Post-thrust, spot the mini echo with 50% size and flat close. Fade by entering opposite on the echo's wick rejection. Stop beyond the thrust extreme, targeting the echo's base or 1:2.5. Common killer, fading too early. Confirm the echo's body is under half the original, ensuring it's a whisper, not a roar. Risk smart. Use 0.3% on Nifty for tighter fades, scaling out at 1:1 to capture the initial drop. Confluence with structure breaks turns it lethal, fading 65% of echoed thrusts into 100 to 200-point retraces. This concept fades the hype, aligning you with the quiet unwind. Diving deeper, the level echo trap preys on repeated tests of a level that echo prior failures, trapping the persistent. A level, like 25,000 on Nifty, echoes when price approaches it again with a candle mirroring an earlier rejection's wick length, but from the opposite side, setting a trap for breakout dreams. Underrated as it blends support/resistance with echo psychology, where institutions echo past traps to reload the same net. The mind trick. Traders remember the level's strength, echoing their bias, only to get snared as price flips the script. On daily charts for context, then 5-minute for precision, mark the echoed wick match within 10 points. Trap entry, on the second echo's failure, enter reversal direction, stop beyond the double wick, target the prior echo's origin. Dodge the pit of overtesting, limit to 2 echoes max, or it devolves to range play. Risk with a 1-4 potential, but cap at 0.4% on Bank Nifty's wild swings, exiting partials on momentum shifts. Stack with compression shadows for 75% traps, ensnaring retail in echoed illusions. This traps 62% of persistent levels, turning memory against the market. Wrapping with the displacement echo chain, where displacements, sudden 200-point surges, chain into echoes that either confirm or break the chain. An initial displacement candle echoes in a smaller surge 3 to 5 bars later. If the echo displaces further, chain continues. Trade with it. If it stalls with a shadow, chain breaks, fade. Underrated because chains look like trends, but the echo break reveals the con psychology. Institutions chain displacements to build narratives, echoing to test conviction before the snap. On 15-minute Nifty charts, track the chain. Enter continuation on echo displacement close, stop at chain low, target chain extension. For breaks, fade on stall shadow. Pitfall, chaining too long, cap at 3 links or overextend. Risk 0.5%, trailing aggressively. Confluence with level traps forges unbreakable chains, hitting 60% with 3-to-1 averages. This chains the surges, echoing institutional resolve. Your playbook, 9 a.m., echo scan dailies for levels and displacements. Hunt 5 to 15-minute echoes in peak hours. 1 per concept? Log the chain, these echo plus 28R monthly by mirroring smart money. Favorite, false echo or displacement chain? Comment it, like, subscribe. Next, echo confluences, trade echo. See you in the next video. Keep trading.